Stronger portfolios in 2026 tend to share a few common characteristics: more conservative loan-to-value ratios, liquidity buffers to absorb periods of higher costs or slower progress, well-maintained assets that remain lettable and financeable as standards rise, a clear understanding of how each property fits within the wider portfolio, and the flexibility to adjust if funding, regulation, or market conditions change. Next, cash flow resilience matters more than portfolio size. Owning more properties doesn't automatically mean a stronger portfolio. For many years, large buy-to-let portfolios were built in an environment where mortgage interest was fully deductible against tax. The introduction of Section 24 fundamentally changed that equation, increasing tax pressure on personally held leveraged portfolios and materially altering post-tax cash flow. One clear response has been a rapidly growing shift towards limited company ownership, particularly for new acquisitions, as investors look to regain interest deductibility and manage tax more efficiently. But that shift also means cash flow, funding costs, and extraction planning now need to be thought through much more carefully. What matters now is how a portfolio behaves under stress, how sensitive it is to interest rate changes, how quickly voids or arrears create pressure, how much headroom exists once tax and compliance costs are fully factored in, how dependent returns are on refinancing assumptions holding up, how exposed the portfolio is to changes in lending criteria, and how easily issues in one property spill over into the wider portfolio. If a portfolio only works in a best-case scenario, it's fragile. The strongest portfolios today are built to cope with delays, surprises, and imperfect conditions, because those are no longer exceptions, they're part of the normal market behaviour.